Right now, 106 million Americans have no life insurance at all, and tens of millions more are dangerously underinsured. The average American household, they're one car accident, one diagnosis, one funeral away from complete financial collapse. And the worst part, most of them think they're covered. Welcome to Insure Smart. Today we're doing a deep dive into the world of insurance, life, health, and auto. And we're going to expose the gaps, the myths, and the critical mistakes that could leave your family exposed when they need protection most. Stay with us. This could be the most important financial education you watch all year. Here's a dangerous myth most Americans believe. If they have some insurance, they're protected. But insurance isn't binary. It's not have it or don't. The real question is whether you have the right coverage in the right amount for the right risks. And a staggering number of Americans fail that test. Studies show that 44% of Americans couldn't cover a $1,000 emergency expense without going into debt. Think about that. If a medical bill, a car repair, or a lawsuit hits the wrong family at the wrong time, a policy they paid thousands for might still leave them financially destroyed. Let's start with life insurance, the foundation of any financial protection plan. Life insurance exists for one reason: to replace your income if you die. That's it. It's not an investment. It's not a retirement vehicle. It's income replacement for the people who depend on you. So who needs it? If anyone relies on your paycheck, a spouse, children, aging parents, a business partner, you need life insurance, period. And yet, a recent survey found that nearly 40% of Americans who need life insurance either don't have it or don't have enough. The coverage gap in the United States now stands at over $12 trillion. That's trillion with a T. Now here's where most people get lost. Term insurance versus whole life insurance. Term is exactly what it sounds like. Coverage for a specific term, usually 10, 20, or 30 years. You pay a monthly premium. If you die during that term, your beneficiaries receive the death benefit. Simple, pure protection. A healthy 30-year-old can get a $500,000 20-year term policy for as little as $25 a month. But whole life insurance? That's a different animal. Whole life combines a death benefit with an investment component called cash value. Premiums are 5 to 15 times more expensive than term. And here's the truth the insurance industry doesn't love to advertise. For most middle-class Americans, term insurance wins. Buy term and invest the difference. So how much life insurance do you actually need? There are several formulas, but the most straightforward is the dime method. Debt plus income times 10 plus mortgage plus education. Add up all your outstanding debts. Take your annual income and multiply by 10 to replace a decade of earnings. Add what you owe on your mortgage. Add estimated education costs for your kids. That total is your baseline coverage number. Many financial planners suggest even more, because inflation erodes purchasing power and life gets more expensive, not less. The point is this: employer-provided life insurance, typically 1 to 2 times your salary, is rarely enough. It's a starting point, not a destination. Now let's talk about health insurance, where the real financial landmines are buried. Having health insurance does not mean your medical bills are covered, not by a long shot. And millions of Americans learn this the hard way, every single year. Here's the vocabulary you need to understand before you sign anything. Your premium is what you pay monthly just to have coverage, whether you use it or not. Your deductible is what you pay out of pocket before your insurance kicks in. For individual marketplace plans, the average deductible in 2024 was over $4,500. Your copay is the fixed amount you pay per visit. Your coinsurance is your percentage after the deductible. And then there's your out-of-pocket maximum, the most you'll pay in a given year. For 2024, that cap was $9,450 for individuals. But the hidden trap that catches the most people? It's the network. Insurance companies negotiate rates with specific doctors and hospitals. Go out of network, and you could be billed the full uninsured rate. which can be 5 to 10 times higher. People have been hit with $100,000 hospital bills because their ambulance took them to an out-of-network facility. They didn't choose it. The ambulance made the call, and their insurance said, "Not our problem." This is why reading your summary of benefits before a medical event is not optional. It's essential. Know your network. Know your deductible. Know what triggers your out-of-pocket maximum. Because by the time you're in a hospital bed, it's too late to read the fine print. Now, let's shift to auto insurance. The one almost everyone has, and the one almost everyone gets wrong. Most drivers focus on price and grab the minimum required by law. But state minimums are shockingly low. In some states, the required liability coverage is just $15,000 per person, $30,000 per accident. If you cause an accident and injure someone severely, those limits are wiped out in minutes, and you're personally on the hook for the rest. There are 4 coverage types that most drivers underestimate or skip entirely. First, uninsured motorist coverage. 1 in 8 American drivers has no insurance. If one of them hits you, your own insurance covers the damage, but only if you have this coverage. Second, underinsured motorist coverage. Even insured drivers often carry minimums that won't cover a serious accident. Third is umbrella liability coverage, a policy that sits on top of your auto and home insurance and extends your liability protection into the millions. A $1 million umbrella policy typically costs just $150 to $300 per year. It's one of the best kept secrets in personal finance. Fourth is gap insurance, critical if you're financing a car. If your car is totaled, your standard insurance pays out the current market value. But if you owe more on your loan than the car is worth, which is common in the first 2 years of ownership, you're stuck paying the difference. Gap insurance covers that gap, and it usually costs less than $5 a month. These aren't luxury upgrades. They're the difference between a covered claim and a financial crisis. So how do you build a protection plan that actually works? Start with an annual insurance review. Every year, your life changes. New income, new dependents, new assets, new risks. Your insurance needs to keep up. Second, shop your policies every 2 to 3 years. Loyalty rarely pays in insurance. New customers often get better rates than long-term ones. Rate comparison takes an hour and can save you hundreds per year. Third, bundle your policies. Auto and home insurance with the same carrier typically gets you a 10 to 25% discount, sometimes more. Fourth, work with an independent insurance broker, not just a captive agent. A captive agent works for one company. An independent broker shops dozens of carriers to find your best rate and coverage combination. Fifth, read your policy documents. I know, not exactly a thriller, but the exclusion section is where claims die. Know what isn't covered before you need to make a claim. Here's the truth about insurance. It's not the most exciting topic in personal finance, but it is arguably the most important. Because wealth isn't just about what you build, it's about what you protect. A single uninsured event can erase decades of savings. The right insurance, chosen with knowledge and intention, is one of the smartest financial moves you will ever make. If this video gave you even one insight that changes how you think about your coverage, that's a win. Subscribe to Insure Smart for more deep dives like this one. New videos every week, because your financial future deserves more than guesswork. Hit that subscribe button, ring the bell, and we'll see you in the next one.